In this video, we're going to be asking the question, what the heck is going on with home prices? My name is Phil Wells. I'm a real estate agent that likes to keep up to date with the market, and I want you to be as informed as possible too. In this video, we're going to look at home price trends. We're also going to look at the key factors weighing on supply and demand in the housing market right now. Starting with home prices. It's not breaking news to say that home prices are up from last year, and they've been up since the lows of the Great Recession, back in 2008-2009 time. Now though, it looks like that trend is heading downwards for the first time in a while. According to Black Knight, home prices fell 0.98% in August from the month earlier, following a 1.05% drop in July. Together, they represent 2 straight months of significant pullbacks after more than 2 years of record-breaking growth. The price declines are the sharpest since January 2009, when the economy was in the midst of the worst recession since the Great Depression, according to Black Knight. Home prices are down 2% since their peak in June. Here in Spokane, that news is a little more pronounced. Since their highs in May, home prices are down around 8% here in Spokane. So what's happening? Why are home prices beginning to fall? Let's look at why this is happening by examining the key factors weighing on supply and demand, starting with demand. Most people in the United States are buying a home with the use of a mortgage. So keeping an eye on mortgage rates and mortgage application rates is a great way to see what direction buyer demand is heading in. Mortgage rates just went above 7% for the first time in decades, and mortgage application rates are at all-time lows. This comes after years of price gains that happened while the Federal Reserve was holding the Fed funds rate at around 0%. And mortgages with a 2 handle were not uncommon. I want to explain this in a little more detail by way of an example. Let's look at someone trying to buy a median-priced home here in Spokane. That purchase price would be around $420,000. Last year, when rates were at 3%, it would have required an income of around $58,000 to purchase this home. This assumes the buyer can use their full allowable 43% debt-to-income ratio and is putting 10% down. When rates climbed to 5%, suddenly that same buyer needs an income of $70,000 to purchase the same median-priced home. Now rates are close to 7%, that same buyer needs an income close to $85,000 to purchase the same median-priced home. That's a nearly 50% increase in the income required to buy a median-priced home in the space of less than a year. Because of this, home prices have to come down. Obviously, there are plenty of households out there that earn $85,000 and can afford to buy this sort of home. But that doesn't mean they're automatically going to go out and buy a home just because that's what they can afford. This doesn't account for the perception of value. Rates have only been this high for a few months now, but already people are finding that they're only able to qualify to buy homes in less desirable areas or smaller, less desirable homes, when compared to what they could have bought last year and what their friends did buy last year. Thus, prices are falling to account for this perception, and I expect them to continue falling while rates are this high. There's no real inherent value that you can calculate in a home. There's no earnings per share like in the stock market or a book value like in the stock market. Thus, a median-priced home should be worth what a household earning the median income can pay for it. And since that amount has shifted due to interest rates, so too must home prices. I want to point out quickly that I'm not a lender, and I'm sure there's more nuance that went into that debt-to-income ratio and income required calculation than I included, but I think it illustrates the point pretty well. So that's what's happening with demand, but let's discuss why those factors are in place. Why are rates so high? This is because, in my view at least, the Federal Reserve missed their opportunity to combat inflation when it first started to bite. Instead, they called inflation transitory, and they crossed their fingers and hoped that it went away. Now we have official inflation at 8.3%, although many argue it's much higher. And we're facing the prospect of the Federal Reserve raising the Fed funds rate to 4.6% in 2023. The Fed seems hell-bent on combating inflation, no matter what the cost. In fact, Jerome Powell came out recently and said he's prepared to see a correction in the housing market and the subsequent loss of home equity just to combat inflation. The Fed funds rate is currently 3.25%, and mortgage rates are in the high 6% range. I anticipate mortgage rates in the 8% range if the Federal Reserve comes through and raises rates to 4.6%. Why do I say if, you might ask? The answer, I believe, and stick with me here, lies with Teddy Roosevelt and the Bank of England. Teddy Roosevelt famously advised that you talk softly and carry a big stick. The idea being that if you have real power and real clout, you don't need to shout about it, you just need to act when the time is right. What we have now is a Federal Reserve shouting extremely loudly and, in my opinion, carrying a twig. They know full well that they can't continue to raise interest rates in the face of an economic downturn. We have a situation in the US where we're facing high inflation and an economic downturn. The Federal Reserve is going to have to choose which is the greater moral evil to combat, and I think we have some idea of what they're going to do based off what the Bank of England just did. So let's shed some light on this situation and head over to my homeland, the United Kingdom. Their inflation is 10%, and the Bank of England, until very recently, was singing from the exact same hymn sheet as the Federal Reserve by wanting to combat inflation above all else. That was until the pound plummeted recently to near parity with the US dollar, and the Bank of England responded by launching a round of quantitative easing, which involved buying billions of pounds worth of government bonds, thereby loosening the monetary supply. To combat inflation, you raise rates and tighten the money supply. To combat recession, you lower rates and loosen the money supply, and it seems like the Bank of England has decided to combat recession rather than inflation. And this has got a lot of people talking about a Fed pivot next year. Can the Fed really continue to focus on combating inflation while we've been in recession since the start of 2022? My gut says there's a pivot on the horizon and lower rates are to come. Watch this space. So we can see there's a major bottleneck in the market, and it's on the demand side of the equation. Let's not ignore the supply side of the equation though. Let's take a minute to look at what's happening there. Housing supply was a major issue for the past few years, and many people point to short supply as one of the many reasons that home prices went up so fast in the last few years. According to figures from the National Association of Realtors, housing supply is increasing and is currently at around a 3-month supply. However, it's coming from such a low that we're still technically in a seller's market territory when it comes to housing supply. But no sensible person right now could conclude that we are in a seller's market given everything else that's going on. I wanted to pick up on the research that we touched on before that showed that home prices are going down because they also mentioned something to do with housing supply. Historically low inventory along with record low interest rates was one of the key drivers behind US home prices seeing essentially a decade's worth of appreciation in just 2.5 years. Inventory levels have been improving though, with overall inventory and months of supply rising sharply from May through July. We'd climbed from 1.7 months of for sale inventory to 3.1 months before improvement stalled in August as sellers appeared to take a step back from the market. Inventory grew at just 1/10 the rate it had been, with the market still some 600,000 listings short of normal pre-pandemic levels. It will be worth watching inventory levels closely in coming months for any sign of a shift in seller sentiment. Right now, prospective sellers are not only coming to grips with falling demand and declining prices due to sharply higher interest rates, but they also have a growing disincentive to give up their own historically low mortgages in this environment. Some may be waiting out the market to see if demand and prices return in spring. So if the Fed does pivot on interest rates, are we just going to find ourselves back to where we were with low rates and low inventory? And are we going to see the return of the dreaded bidding war come next year? I certainly hope not. My blood pressure can't handle another 3 years of bidding wars. So that's it for this video. I don't claim to have all the answers. This is just the perspective of someone that watches the housing market and economic news very closely. If you gained from this video, please like and subscribe. That really does help me out. As always, my name is Phil Wells, and thank you for watching.